All right, guys, I figured I'd just upload a video to kind of talk a little bit about volatility and the way I see it in the market and how to identify a region where volatility is likely to expand and where you can reasonably expect that to happen and how to know when to stand back from the market in those areas. So right here, I've got this low marked off. It's a weekly low. You can see it's a little bit of a stop run violation below here. But it's pretty clearly defined, and we can see that price comes up, retests that low, and that offers you a pretty decent shorting opportunity right there. You can also see this level on the daily. It's a little bit better defined, of course, as we go down in the time frames, but you can see here, price comes down, hits it. You didn't see this distinction on the weekly, but of course here it's on the daily. A little bit of a retest, almost a perfect retest. Not instant, price kind of bounces off there, trades lower. Then ultimately you get this throw over. But the point I'm trying to illustrate here is that this is a high time frame level, clearly seen on the weekly and the daily. So now I'm going to go and move down to the intermediate time frames. We'll start out with a 4 hour. Yeah, and you can see the same sort of deal, right? We have we originally have the break of a low. If we go here, and you can see as the low breaks, right? You could use this area for a stop market order, but as price starts breaking through that level, it starts to really pick up speed, and pick up speed quite quickly. Of course, it doesn't retest it exactly. It um, spends its time around here. Ultimately, starts breaking up higher here. You can see this here. This is a classic thing right here, and I'll do another video on this. But whenever you see this type of signature, right, you have your you run of your lows, fills a price extension, maybe comes up, fills a gap, but then you get this push lower, and then price starts closing back up in the consolidation. Then you can mark off these highs right here, the pretty intermediate, or the highs nearest to price action. If you get those highs broken, uh, it's a pretty good sign that price is going to start moving upward and filling these higher price distinctions. But anyway, we've got this. So you can see price starts working its way up towards these higher levels. And if you're not aware that these high time frame levels, then you might expect, right? You might be playing this area right here, and it's a decent trade, right? It comes down, tests this high, comes back up. If you're pulling in equity, you can you can make a good deal of profit on this trade. But if you didn't know that this high time frame level was here, you might be looking for a price to extend further and for this to be a trending move. But essentially what we have is a low time frame trend colliding with your high time frame level. So this is kind of where we see those two time frames collide with each other, and ultimately the high time frames usually end up winning. Not always, but if we're in the betting game, that we have to side with the high time frame trends. So anyway, but the key distinction here is that when you see these low time frame levels collide with the high time frame levels, that's when you can kind of expect that volatility to pick up. And this is kind of frustrating because you may have analyzed this correctly and still end up in a losing trade, right? If you traded this high, this daily and weekly level here, you're in profit for a good amount of time, and then you ultimately get this throw over, this volatility. So kind of the point I'm trying to illustrate here is that this is the area where you can expect volatility. So maybe this is not the time to play so tight to the market. Maybe if we had our entry here, we don't want to necessarily have our stop right above these highs, right? We want to give the market some room to breathe around the high time frame levels. And so anyway, we have this throw over. I mean, this if you're zeroing in on the low time frames, this could look like a very bullish move. But of course, in the context of the high time frames that we're looking at, we know that's probably not the best way to be looking at it. And we really get our confirmation of that idea when we see this, right? When we see the throw over and then the run down. So you can mark this area off right here. This is a major high time frame stop run. And then it slams down. This is where we really have our confirmation. Of course, price comes up a little bit further into there, but not very much. It's you get a pretty clear price reaction after the stop run, expansion and volatility, right? So you get higher highs, lower lows, and then ultimately price just kind of oscillates around a little bit before continuing. But the idea is that you got this high time frame level here, volatility expands, breaks structure, and you get a continuation of the trend in line with the higher time frame idea. And then see, this trade is in line with the higher time frame premise. So this is the type of environment where you don't need to play as tight to the market. You don't have to have your initial take profits so tight, and you can kind of let the trade ride for a little bit. I mean, this is the type of environment that most people like to trade, right? It's the least stressful and the type of trades you can sleep on, wake up the next day and be in profit without really worrying too much.